The Federal Reserve's next big question is no longer about emergency hikes. It's about 2026. Will the Fed pivot toward rate cuts, or will it pause and hold rates higher for longer? After years of aggressive tightening to fight inflation, the Fed is now walking a narrow path. Inflation has cooled from its peak, but it hasn't disappeared. At the same time, economic growth is slowing, and cracks are beginning to show in consumer spending, housing, and business investment. A pivot would mean the Fed starts cutting interest rates in 2026 to support growth and prevent a deeper slowdown. This would likely boost stock markets, lower borrowing costs, and provide relief to consumers and businesses. But there's a risk. Cut too early, and inflation could come roaring back. That's why many policymakers are signaling a pause-first strategy. Instead of rushing into cuts, the Fed may hold rates steady for an extended period, watching inflation data, job numbers, and wage growth very closely. For markets, this uncertainty matters. A pause keeps pressure on borrowers. Mortgages, credit cards, and business loans remain expensive, but it also sends a message that the Fed is serious about price stability. So what's more likely for 2026? If inflation continues to trend down and the labor market weakens, a gradual pivot becomes more realistic. If inflation stays sticky, the pause could last much longer than investors expect. The Fed's 2026 roadmap isn't about choosing growth or inflation, it's about timing.